Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
First of all, I want to say, hope everybody had a happy 4th of July.
Woo!
We definitely had a happy 4th of July. We had a lot of fun. We'll tell you all about it on the next video. But we're going to talk about mortgage rates, where to go find some pretty good mortgage rates, and what we think mortgage rates might do throughout the rest of the year, maybe into next year, and talk about what the chances are the Fed will change rates and how all that works, right? Okay, so Wanda, let's start with this. We're just going to start with a baseline, which is, we'll throw this up there. This is the primary mortgage market survey. This is from Freddie Mac. What they did is they take every possible loan product there is, no matter what your credit score is. So super high credit scores, super low credit scores, and they do a survey. So for the last week basically, 30-year fixed rate mortgage was 6.77% for a 30-year. That was the average for all types of 30 years. 15-year, 5.89%. Okay, first of all, why is a 15-year, to the people who don't understand, why is a 15-year fixed rate mortgage lower percent?
Well, because the duration of your loan is shorter, so then the duration of the risk is shorter.
Oh, so it's about risk.
Right.
This is why those like adjustable rate mortgages tend to be really low too. They're like 5 or 7 years, and then after that you have to refi it because they're just transferring all the risk to you, right? Which payment is going to be higher? So a 30-year mortgage or 15-year mortgage, which of the payments are going to be higher?
So generally, the 15-year mortgage, the payment's going to be higher.
Well, why is that when the interest rate on the 30-year is more? Why would the payment be higher?
The principal on the 30-year is spread out over, the repayment is spread over 30 years versus the principal being spread out over 15 years. Okay,
so with that, yeah, that's exactly right. So 15-year mortgage is going to be more. So the question is do you roll the dice, or do you wait 2 years and maybe, because there's like a refi boom going on right now.
There is. And this happens periodically when rates dip below what people think was a higher point in the market, so people go out and refinance. Particularly when interest rates are higher, lenders will say, okay, well, I will do your refinance for free. Now, there's no such thing as a free lunch. So, there are fees in there usually, and what they'll do is they'll roll those fees back into your loan, so it kind of looks free, but it really isn't. So it depends on the lender and their program. But I know that over the last 2 or 3 years, there were certainly many lenders who said that that they would do the refinance either for free or at a reduced cost or something like that to get people to say, hey, you know what, I'll go ahead and take out this loan now, and then later when rates go down, I'll be able to at least more affordably get my rate down when I refinance.
What's interesting too about this chart, as you can see on the bottom, that is, these are interest rates going back to 1970. We have lower rates than we had about the same rates that we had in 1970. Of course, from 75 really to probably 2000, interest rates were higher than they are now. This idea that interest rates have always been 2% or 3% only happened twice ever. It happened in the 1950s, right? And it happened just recently.
Right.
So with that, what I want to do now, Juana, is let's first talk about the Federal Reserve. Now, we're going to put this up on the chart. We'll talk about this, and we'll talk about how this affects mortgage rates. Okay, so the Federal Reserve meets, and they set interest rates for the federal funds rate. And what they're setting is the rate that banks pay the Federal Reserve on overnight loans.
Right.
The federal funds rate. Okay. How does that correlate, if at all, to mortgage rates? Does that because you just saw the mortgage rates don't look anything like the current federal funds rates.
Right. So everything kind of works together, right?
Okay.
There's not a one-to-one ratio, certainly, but everything kind of works together because it influences other monetary instruments. For example, it influences treasury bills and that sort of thing. And so all of that works together to kind of all ships rise together and all ships sink together sort of thing.
It's kind of like if you turn on a water spigot, it takes a while to see the water fill up a thing.
Right.
But if you know the water's coming, you react. So for example, interest rates climbed in 2020 faster than the federal, for mortgage rates, climbed faster than the Federal Reserve because people could see borrowing was getting more expensive. So the cost of borrowing increased. And this include 10-year treasuries, includes mortgage rates.
Right.
The same thing tends to happen. You'll see interest rates potentially drop and price in these cuts the Federal Reserve will make possibly before they happen, especially if they're highly predictive that they'll happen.
Right. So remember, the market is forward-looking, so it's anticipatory. So think of it this way. The Federal Reserve makes a move that influences Treasury bills, and Treasury bills are the basis for mortgage rates. So that's kind of how that sort of works.
Yeah, there's been this unwritten rule that the banks, that the mortgage lenders are basically buying 10-year mortgage, 10-year Treasury bills as their hedge. So what they're doing is they're letting you borrow money at that exact amount. So they're basically, and then they charge you fees. So they're basically borrowing money, loaning money to you at the same rate they're borrowing it from, so to speak, to loan you the thing. They charge you a little bit of a premium on it, right? And then they charge you some fees. That's how they make all their money. Right. So the mortgage rates tend to go along with the 10-year. Now, what's interesting about this, we're going to talk about these. So the current rate is 4.25 to 4.5%. Now there's this consensus that by September, that there's a 93% chance that the market has predicted a 4.25, so a 25 basis point drop, right?
Okay, but they've been wrong most of this year, just so we're very clear on
Yeah,
that.
there were a bunch of times they said they would and they wouldn't. And then last year there were supposed to be 7 or 8 cuts, so I think there were 2.
Right.
Okay, and then another one in October. It could be 2 more by the end of the year, but could be two completely different months. But
right. Okay, so in the comments, put down how many times you think the Fed's going to cut rates this year.
Okay.
I think twice.
Okay, now, this is what's interesting about this. And you see down the bottom the percentages. Like there's actually 20% that think they'll cut it July 30th.
No.
And that's if Trump doesn't fire the Fed chairman and put himself in as Fed chair. Then there's a 100% chance they'll be lower, substantially lower. I think you see us cut them to 1%. Okay. Historically, we've had 3 scenarios with the Fed and interest rates. They have either been increasing, which tend to happen over a short period of time. Okay. They've tend to be stable, right? Or they've tend to be cut over a long period of time.
Right.
Which of those phases do you think we're in? Do you think we're at the point where the Fed is probably going to spend they're going to be stable, or Fed is going to take a long period of time to cut rates, like this long rate cycle?
Okay, so it's been stable, actually.
It's been stable for 3 years.
Yeah, it's been very stable for the last few years.
Okay.
And I think that we are entering a very slow rate cutting cycle. And so if you're thinking that rates are going to go to a very attractive level anytime soon, I'm sorry to disappoint you. I don't think that's going to happen. I think, like I said, the Fed will cut rates this year. I think it'll probably be 2 rate cuts. I don't think it'll be more than that. So I'm not suspecting that it's going to be more than half a basis point. I could be wrong, but I think that's where we are. The Fed, I think, is very conservative. I think the Fed is very concerned about tracking the numbers. Unfortunately, the way we track numbers is pretty archaic, and so we're very slow to get good data. That's why you see continually revised numbers. So it makes it very difficult for the Fed to know in any sort of real time or even a short amount of time an accurate read on the economy. So they're very concerned with inflation because inflation is really difficult to beat back. So rather than making a mistake and cutting rates too quickly and having inflation take off again, which is really hard to beat back, they're going to just take their time with the rates. They're going to take their time with the data and do their best to keep inflation at bay.
Okay, but this is the same Fed that waited too long to raise interest rates.
Right.
They were doing quantitative easing. They were buying securities, which is putting more money into the economy, right?
Which is exactly why they're going to be slow to this, because they were slow on that side and things didn't go well. So they're going to be slow on this side so that they don't get back to that inflationary situation.
They literally could see the inflation and called it transitory.
I appreciate that. But I think that's what I think they're concerned about having that happen again, so they don't want to have inflation take off again, and so they're going to be very slow at lowering rates.
I think it's going to be a 3 or 4 year process, not because that's how long Trump is going to be president or whoever. I think it's just going to be, this is what it's going to be. I think it's going to be the slow, methodical. We get a couple rate points. Do we get down to 1% again? I mean, we're basically at 0 to 0.25. We were 0 to 0.25 for a while. I don't know if people remember this, but remember in 2019, we had a massive, the Fed raised rates substantially, and then all of a sudden they put it back to 0. Do you remember that?
Yes,
we had like this, the rates went up and everyone thought, oh my gosh, is this the economy thing? And then they went back down.
Right.
And that might have been COVID. Okay, now with all that in mind, what I decided to do was see if I could go online and find some pretty interesting rates for mortgages.
Okay.
So what I did was I went on the Navy Federal Credit Union. Do not have to be in the Navy. However, this was the first place I ever banked when I was at the Naval Academy. They had a Navy Federal right there on the Academy, and then we all got accounts.
Mm-hmm.
That matter of fact, that's where basically put the $80 a month that we made.
Okay.
No, actually, I think it was $60. And I get $60 a month that they put into our account. Okay, so on the NFCU site, Navy Federal, 30-year fixed, 6.12%. That's with 0.25% discount point, so a quarter point. That's a smoking rate. 30-year jumbo. What's a jumbo?
So jumbo is depending on your market. So for Vegas, a jumbo is about three quarters of a million.
Okay, it's a high. It's not conforming, right? It's a big house. Okay, 5.25% for 15-year. Now remember, this is not the average person. Now remember, these are fixed. These are mixed into that first chart we showed you, the Freddie chart. Because these are on the lower end. There's going to be places where the rates are even higher because you probably have a 580 credit score and who knows, and there's 0 points, right? So here you've got a little bit of points on it. But I was looking through these and you had to have like the worst credit you could have for any of these was 720 and the highest on 1 or 2 of these was 780. So this is like super A paper, right? If you've got a 780, you can probably right now go out and get a 30-year 6.125. Actually just talk to a guy who just bought a house in Napa, $925,000, I think he said it was, and he got a 6 1/8% on it without a huge down payment. Some of these too, they require like 20% down.
Sure.
So this is just, I thought this was interesting. And then also in here one of VA loans. Now, if you notice the VA loans are even lower. 15 years, 5 1/4, and a 30-year is 5 7/8, with a discount of either half or, and then remember the VA also has some fees that they tend to charge, funding fees and stuff. You get them waived if you have 100% disability, things like that. So the bottom line is there are some, like the median rate 6.77, but there are some, like there's some better, you can get good rates. What's the lowest you've seen? Like, do you see a lot of this? You're only doing broker stuff, so you're probably not seeing their loan stuff.
So I don't see their loan stuff.
Okay.
I occasionally hear about it. And, it's pretty interesting. It depends, primarily it depends on, obviously, the person's credit, debt to income ratio, and how much they're putting down. Because, even when they're borrowing $3 million, they can get pretty good rates because they tend to have good credit, they tend to have good debt to income ratio, and they tend to put a lot of money down.
Right, but some of these people get $3 million and they have assets to back it.
Well,
so they're getting these special, they know they have the money. This is not, I have a job, I just have enough for down payment. You're a much higher risk than somebody who's got $10 million in some stock portfolio, but it's making 13% and you don't want to mess with it. So you'd rather just borrow the money at, 5% or something. And because they know if you default or whatever, they can just go out and get your money.
Well, it's not just that. It's that you wouldn't default. I mean, you have assets that you could liquidate to
make payment
to make the payments.
The average person doesn't have. Like probably most people watching the video here are probably just trying to figure out how buy their first house maybe.
Right, and that's great. And the way you buy your first house is the way you buy everything. You make sure that it fits your budget, that it fits its purpose, and then you go out and pick the best home that suits your needs.
I thought this was interesting when Juan and I started talking about this interest rate thing, because we've been waiting, I think, for 3 years for rates to fall. I would think I was told by a lender like 2 years ago that he said like by next spring rates are going to be much lower, and it didn't happen. And we're actually at the time potentially making a purchase, and I'm kind of glad it didn't in a way. Actually, I am, because the price of that same unit is probably 300,000 more than it was 2 years ago today. But the interest rate would have been a little higher, so it wouldn't have dropped like I thought it was going to drop. But anyway, I think it's going to be interesting next 3 or 4 years, because whatever's happening in real estate, we have a normal supply of homes, and we're getting back to a normal supply of homes. We're also, I think we're going to start seeing mortgage rates slowly drop over the next couple of years. I think. I don't know, but that's my gut feeling.
I think we will. And especially as employment numbers come out, and maybe particularly if the employment numbers are not as strong as people thought they might be, that would give the Fed a little bit of courage to maybe look at lowering the interest rates just a little bit to keep the economy going. Because remember, the Fed's mandate is to keep inflation in check, to keep all of us employed, and just have a stable economy. The Fed has zero interest in anything exciting. They have every interest in keeping everything stable.
Stock market's at an all-time high, but then the dollar's off somewhere between 5 and 10% since the beginning of the year. So, yeah.
Okay.
Yeah.
So hopefully this was interesting to you. Please leave us your real estate related comments. We appreciate them. Remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.